Welcome back to The Boring Currency, the channel where we break down the quiet forces shaping global money and markets. Today's video looks at the silver market and the growing gap between what prices show on a screen and what's happening beneath the surface. We'll explore paper trading, physical supply pressures, and historical patterns that many investors overlook. This isn't hype or prediction, it's context, data, and perspective. Because when markets change, the people who understand the structure are never caught off guard. Listen carefully, because what you're about to hear is not a theory, not a rumor, but a warning. While the price of silver looks calm on your screen, a silent collapse may already be underway beneath the surface, and almost no one is prepared for what happens next. For decades, silver has been marketed as just another commodity, something industrial, something boring, something controlled. But behind the charts, behind the futures contracts, behind the polished reports, there is a shocking imbalance that threatens the entire paper silver system. A market estimated in the trillions, backed by a sliver of real, deliverable metal. This is the paper silver collapse, exposed. Let's start with the number they don't want you to focus on. Depending on how you calculate derivatives, futures, ETFs, unallocated accounts, and swaps, the paper silver market is estimated to exceed $5 trillion in notional exposure. COMEX futures alone regularly represent hundreds of millions of ounces traded on paper, while the actual registered silver available for delivery often sits below 30 to 40 million ounces. At times, it has dipped far lower. That's not leverage, that's a trap. Put it simply, for every single ounce of physical silver that can realistically be delivered, there may be 100, 200, even 300 paper claims outstanding. This is not speculation. It's visible in open interest data, warehouse reports, and ETF structures. The system works only as long as most participants never ask for the metal. The moment that changes, the illusion breaks. And here's the secret. That moment may already be approaching. Historically, silver is not just a precious metal. It's money. For thousands of years, it circulated alongside gold as a store of value. Even in modern history, silver has repeatedly exposed stress fractures in the financial system. In the late 1970s, when inflation spiraled out of control and trust in fiat currencies collapsed, silver surged from under 5 an ounce to nearly 50. That move wasn't driven by speculation alone. It was driven by fear, by shortages, and by people demanding real assets. Fast forward to 2011. After the global financial crisis, silver exploded again, climbing from around 9 in 2008 to nearly 49 in just 3 years. Paper leverage expanded. ETFs ballooned. Futures open interest surged. But once again, the rally ended not with abundance, but with aggressive paper selling, margin hikes, and price suppression. The price collapsed, but physical demand didn't disappear. It went underground. Now compare that to today. Industrial demand for silver is at record levels. Solar panels alone consume hundreds of millions of ounces annually. Electric vehicles, electronics, medical applications, and military technologies all require silver, and there is no substitute with the same conductivity. According to industry data, global silver demand has exceeded supply in multiple recent years, creating structural deficits measured in the hundreds of millions of ounces. Above-ground inventories are being drawn down. That's not bullish sentiment, that's math. Yet despite this, the price remains trapped. Why? Because the paper market is doing its job. On COMEX, massive sell orders often appear during illiquid hours, smashing price in minutes. Thousands of contracts, representing tens of millions of ounces, are dumped with no regard for price, something no rational physical seller would ever do. This isn't hedging. This is control. It's designed to cap rallies, trigger stop losses, and reinforce the narrative that silver is weak. But look closer at the divergence. While futures prices drift or fall, physical premiums tell a very different story. Retail silver coins routinely trade at 20, 30, sometimes even 50% premiums over spot during periods of stress. In some regions, supply dries up completely. Dealers post out-of-stock signs. Delivery times stretch from days to weeks to months. If silver were truly abundant, this wouldn't happen. This is the physical versus paper split, and it's growing wider. ETFs are another pressure point. Products like SLV claim to hold vast quantities of silver, but much of it is unallocated leased, or held by custodians deeply embedded in the same bullion banking system that dominates paper trading. The prospectus language is clear if you read it closely. In extreme conditions, shareholders may not get metal. They get cash. And cash is exactly what investors are trying to escape when they buy silver. This creates a dangerous feedback loop. Paper investors believe they own silver. Physical buyers remove metal from the system. Vault inventories decline. Leverage increases. And the entire structure becomes more fragile with every ounce withdrawn. Now add the macro backdrop. Global debt is exploding. Interest rates have surged at the fastest pace in decades, putting pressure on governments, banks, and consumers. The U.S. alone carries over $34 trillion in federal debt, with interest costs approaching levels that rival military spending. Confidence in fiat currencies is eroding quietly but steadily. Central banks know this, which is why they have been aggressively buying gold at record rates. Silver historically lags gold until it doesn't. In past cycles, silver has dramatically outperformed gold in the later stages of monetary stress. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has often peaked above 80 or even 100 during crises. Historically, that ratio eventually snaps back toward 50, 40, or lower. If gold merely holds its value and the ratio reverts, silver prices would need to rise substantially. If gold rises as well, the move in silver becomes explosive. This is where scenarios matter. In a bearish scenario, paper control continues. Prices stay suppressed. Investors lose interest. Volatility fades. But even here, the cost is paid elsewhere, through ongoing physical shortages and rising premiums. The system limps forward, weaker each year. In a bullish scenario, something breaks. It could be a delivery failure, a major industrial user demanding guaranteed supply, a geopolitical shock disrupting mining or refining, or a financial crisis that drives investors out of paper promises and into tangible assets. In that moment, paper sellers face a problem. They cannot deliver what they sold. When too many players ask for real silver at the same time, the market doesn't adjust. It gaps. Prices don't rise smoothly. They reprice violently. This is how squeezes happen, not because of hype, but because of scarcity. And here's the warning most analysts won't say out loud. The longer silver is suppressed, the more dangerous the eventual move becomes. Every year of deficit, every ounce drained from vaults, every paper contract layered on top of another paper contract increases the energy stored in the system. Think of it like a dam. Calm on the surface, cracks underneath. When it goes, it doesn't leak, it collapses. Retail investors aren't the only ones noticing. Sovereign mints have struggled to meet demand. Large bars are quietly moving from Western vaults to Eastern buyers. Industrial users are locking in long-term contracts. These are not speculative actions. They are defensive. Silver is not just an investment. It is a strategic metal. And strategic metals don't stay cheap forever when supply is tight. So what does this mean for you? It means the price you see on a screen may be the most misleading signal in the entire market. It means volatility is not gone. It's being stored. It means the difference between owning a paper claim and owning physical metal could matter far more than most people realize. Because when trust breaks, it breaks fast. The paper-silver market survives only as long as confidence remains intact. History shows us what happens when that confidence disappears. First denial, then panic, then repricing. This is not financial advice. This is context. This is history. This is a pattern repeating under new conditions. And the final question is simple. When the paper-silver collapse is no longer hidden, will you be watching or positioned? If this analysis opened your eyes, make sure you like the video, subscribe for deep dive investigations like this, and comment below. Do you think silver is being suppressed, or is the system stronger than it looks? The next move in this market may shock everyone who isn't paying attention.